Hey there, welcome to Nebby Invest. Probably my favorite sort of company is a profitable small cap, particularly if that company is overlooked by the general market. Now, I've gone through all the half yearly and yearly reports that were released in February, and I have found a plethora of these sort of companies that are on the ASX. So even though I have the ASX symbol up there, I'm not affiliated with ASX, but the whole point of this video is to go through profitable small cap companies that are listed on the ASX, hence the symbol. So because this is my favorite sort of company, I thought I'd do a video series on this. So this is part one, and I hope to continue this video series for as long as possible because I do think this might be my favorite video series that I have created. So I hope you stay with me. And the whole point of doing these video series is to share ideas. And I think I'll be sharing quite a few ideas with you because few of these companies you might not have heard of, and hopefully I'll give you some inspiration that you can follow up with some more research on any sort of company that you might find interesting. So let's get into it. So this is the agenda for this video. I'll be looking at three profitable small cap companies listed on the ASX. And those three companies are HRL Holdings, TPC Consolidated, and Amber Technologies. Now, for full disclosure purposes, I am a shareholder of TPC and Amber Technologies. Now, for these three companies, I'll be looking at a fact sheet and financials. And when it comes to the financials, I'll be looking at or focusing on revenue and operating cash flow. And then when I'm talking about revenue operating cash flow, I'm looking at the trailing 12 months. And I'll get into that when I talk about the first company. Second thing I'll look at is the historical revenue growth over the past 6 years or so. And the reason I'm focusing on revenue growth is if a company doesn't have revenue growth, then I don't think they have a long-term potential. And if they can maintain any sort of revenue growth, I think there is that potential they can grow not only revenue, but that will go down to the bottom line in profits and operating cash flow. And the last thing I'll look at is the 5-year weekly chart for each company. Now, the reason I'm looking at a weekly chart instead of a daily chart is some of these companies tend to be quite liquid. And when you go from a daily chart to a weekly chart, you sort of weed out that noise that you do find on the daily chart for liquid stocks. So the first company I'll be looking at is HRL Holdings. Now, this is a company I have been following for quite a few years, and the main reason I am following this company is they are an environmental services company, and these are some of the services they provide straight from their website. So the main reason I have been following this company is I do believe this sort of area or sector has potential to grow quite well over the next decade, 20 or 30 years or so. Now, even though they are growing revenues quite well, and I'll show that in the next slide, the market cap and the share price hasn't been growing with the revenue growth, and I believe that has the potential to change when you look at some of their numbers in regards to revenue and operating cash flow. So revenue and operating cash flow here, 32.9 for revenue and 8.8 for operating cash flow, is the trailing 12 months. So what does trailing 12 months mean? It's mean I take the most recent half-yearly numbers and add that to the second half of last year's financial numbers. That's the trailing 12 months. And you can see revenue, again, 32.9, but the operating cash flow is what has got me really interested in HRL Holdings, 8.8 million. It's a fair bit higher than the profit they've stated. But the thing about operating cash flow and profit is I focus mostly on operating cash flow because in my opinion, that is a better indication of how a company is performing. They also have net cash. So that's net debt minus 3 million, which means they have net cash of 3 million. And a valuation metric that I tend to use more often than not is enterprise value to operating cash flow. You can think of that as sort of a PE ratio, just looking at two different metrics. So enterprise value is looking at the market cap and minus or plus any debt or cash, and operating cash flow is fairly obvious. And to put it in context, the numbers I look for here, anything less than 10 is a sign a company is sort of in a good value range, and anything less than 6 is screaming out value. So at this point in time, HRL Holdings, enterprise value to operating cash flow is 6.9, so it's heading towards a really good value. And the main reason for that is that operating cash flow of 8.8 million has grown quite substantially over the last few years, and the market cap hasn't grown in relation to that increasing in operating cash flow. So here is HRL Holdings' revenue growth over the past 6 years, starting in 2015. So in 2015, they had $4.7 million in revenue growth. Now, the main reason I like to follow revenue growth is because if a company can't maintain any sort of revenue growth moving forward, then I don't think they'd be able to grow, because the only way they can grow profits and cash flow, if their revenue isn't growing, is by cutting costs, and that's not a sustainable way to grow profits. But anyway, so that's the main reason I look at revenue growth and sustainable revenue growth. So you can see revenue is growing over the past 6 years, going from $4.7 million in 2015 to $32.8 million in the last financial year, which is a compound annual growth rate of 47.7%. Now, something to keep in the back of my mind and your mind is that revenue growth has slowed over the past couple of years. So it could be sort of heading towards a period where it's not growing much at all. So I'd like to see this company start to really build up that revenue growth moving forward. I did make an acquisition, I did see in the announcements recently. So I'm hoping they don't try to get revenue growth through acquisitions. I hope they try to go down the organic growth sort of road. So this is the 5-year weekly chart. Again, the reason I like to look at the weekly chart is to weed out all the noise you do find on a daily chart. Now, HRL Holdings isn't as liquidly traded as the other two companies we've been looking at, but you can definitely see some interesting things when you look at the 5-year weekly. In particular, if the price gets down to around 8 cents, that's a screaming buy. So it's got down to 8 cents 3 times back in 2017, 2019, and 2020. And all 3 times, if you bought in at 8 cents, you would be, in profits right now. And then if the share price gets to above 16 cents, that would be a sell signal. So right now, it's around 13 cents or so. So it's right in the middle of that range. Next company I'll be looking at is TPC Consolidated. Now, this company is an electricity retailer, and I think they provide it to SMEs as well. Now, their subsidiary is called CoverU, COVAU, and I've never heard of it before I started researching this company about 7 or 8 months ago. Now, when I first started researching this company, it was all about how well they respond to wholesale gas and electricity prices. You can see a little blurb they've mentioned in their report how their margins have really increased over the last 6 months because of exceptionally low wholesale gas costs. So this company's profits are highly dependent on the wholesale prices of gas and electricity. So in a way, they're a price taker just like a miner. So how well they've done over the last 6 months may not continue just because of the wholesale changes in prices of gas and electricity. Now, in saying that, their financial numbers over the last half year have been quite exceptional. Now, the market cap before the start of trading on March the 1st was 24 million. No doubt that has gone up because the share price of TPC is increasing. Revenue for the last 12 months is 86.5 million. The operating cash flow is 7.9 million for the last 12 months, but the last 6 months it was around 7 million. So $7 million in operating cash flow for 6 months for a company with a market cap of 24 million should in itself be screaming out value, but the market will be probably saying, or there will be some detractors saying, this exceptionally low wholesale gas costs won't continue in the future, and more than likely it won't. They also have $7 million of cash, which means the enterprise value is 17 million, which means the enterprise value to operating cash flow is 2.2. So if you remember from one of my last slides, anything less than 6 is screaming out value. So as a shareholder in this company, I'm very happy with this last half-yearly report, but I do know that that sort of numbers, that sort of financial half-year probably won't continue for the future. But even if it doesn't continue, this company has become profitable, operating cash flow positive, and they've also issued another 8-cent dividend. So they issued an 8-cent dividend for the final one last August. They've issued another 8-cent dividend. So it's 16 cents of dividends when I bought in this company at 90 cents. So my dividend yield right now is about 20%. And here is the all-important revenue growth for TPC. And they really grew their revenue quite quickly from 2015 to 2018, going from 24.5 to 80.2 as they expanded their retail electricity business or energy business into more states, I think, or quite rapidly through Victoria and New South Wales. Anyway, now over the past 3 years, that revenue growth has tailed off. So even though we do have a compound annual growth rate of 28.6%, that's significantly lower over the past 3 years. So the main reason I've used the 5-year weekly chart again is because this company, TPC, was really highly liquidly traded. Even before I bought it, or after I bought it, has been illiquidly traded. So I bought it in August of last year at 90 cents. You can see back in 2016 to 2017, there was this peak in share price. So I wanted to understand why that happened. And they did put out a presentation in November of 2016, which they did said, I think in that presentation, they said they were going to be profitable in the next year, but they did not become profitable because, here's the important thing, because of the wholesale electricity prices were higher than expected, and that put some pressure on their margins and their profit. So again, wholesale prices of gas and electricity is very important for this company. And over the past, we'll say 9 months or so, those wholesale electricity and gas prices have been coming down, and that's why you're starting to see more people come into this business and why the share price is increasing. So here is an interesting screen grab I got this morning, 1st of March, just after open. Now, TPC released their half yearly just after close on the Friday, so we had to wait till Monday to see the market reaction to the half yearly. And of course, it's been positive, just like I thought it will be or would be. So this is just a screen grab of the buyers and sellers about 20 minutes after open, and there was only one seller willing to sell their shares at $99. The share price at the time was about $2.32. So plenty of buyers in there to buy for anyone who wanted to sell. So this sort of reaction from the market was not unusual to see, but this is what you see with highly liquidly traded companies. Sometimes if there's some good reports coming out, good news coming out, you won't see any sellers, but plenty of buyers, and that can really force up the share price quite quickly. And of course, the reverse is true. When you have a highly liquid company, if some bad news comes along, the share price can plummet by quite a bit because there won't be a lot of buyers wanting to come in. The final company I'm looking at is Amber Technologies. So they are a distributor of audiovisual solutions for all types of projects. They do have some impressive clients. I was looking at some of their one of their presentations, and they have some very impressive clients, including the military, Australian Defence Force, and a lot of governments. So a very impressive client base, but just because you have that sort of client doesn't mean you're going to be highly profitable. So Amber Technology, ticker code AMO, market cap only 18 million, so fairly low again. Another company that has a very low market cap, yet fairly high revenue, $72 million in revenue, only operating cash flow of 2 million, so not quite as high as the other two companies, and net debt of 3 million. So they do have an enterprise value of 21, which means the enterprise value to operating cash flow a little bit higher than the other two companies. Right on 10. So I wouldn't say this company is great value. And the main reason I do like this company is the revenue growth we are starting to experience over the past 6 to 12 months. Now, in saying that, this is the compound annual growth rate of the revenue for Amber Technologies since 2015, only 3.2% per year, from 50 million in 2015 to 58.7 million in 2020. But once we get to see the 2021 numbers, which should come out in August, that number, that compound annual growth rate will increase because they did do an acquisition recently, and that's really come down to the bottom line, or helped the bottom line, because revenue for the last half year was about 38 million. So revenue for the full financial year should be significantly higher. Now, if you know anything about me, you do know I'm a little bit wary about acquisitions, but that's usually for bigger cap companies, because research has shown us that acquisitions, or where big cap companies do acquisitions, it tends to lead to shareholder negative returns or negative shareholder returns. But when small cap companies do acquisitions, it tends to increase shareholder returns. And here is the 5-year weekly chart for Amber Technology. And you can see a lot of interest has come into this company since about, would have been not September, October of last year, because in that time they did put out a very positive trading update, and I think the share price went up 100% based off that trading update, and we've seen a very good peak in volume with that. We did see the volume back off a little bit, but the share price went sideways, and then when they released a half-year report last week, we did see the share price pop up again on really high volume. So this is a thing I really like to see in a small cap company like Amber Technologies, is this expansion in volume that can be very bullish, particularly if the share price is increasing, coinciding with that volume increase. So I hope you've enjoyed this video on profitable ASX small cap companies, TPC Consolidated, Amber Technologies, and HRL Holdings. If you do have any questions about any of these companies, leave in the comments section, and eventually I'll answer any comments you do have. Might take me a few weeks, maybe even a month, but I'll eventually answer every single comment. Now, I'm not a financial advisor, so if you do need financial advice for your own circumstances, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. See ya.